Today, we will talk about enterprise value, EV. Enterprise value is a measure of a company's total value, used as an alternative to market capitalization. It includes not only the market capitalization of a company but also its short-term and long-term debt and any cash or cash equivalents on the company's balance sheet. Enterprise value uses figures from a company's financial statements and current market prices. The components that make up EV are market capitalization, total debt, and cash equivalents. The enterprise value formula is calculated by adding the company's market capitalization to its total debt and then subtracting its cash and cash equivalents. EV tells investors or interested parties a company's value and how much another company would need if it wanted to purchase that company. It differs from market capitalization and gives a more accurate representation of a firm's value. Enterprise value is used as the basis for financial ratios that measure a company's performance. One example is the enterprise multiple, which relates the total value of a company to a measure of operating earnings generated. EBITDA measures a company's income before interest, taxes, depreciation, and amortization. EBITDA is used as a financial metric without the drawback of removing depreciation and amortization expenses related to property, plant, and equipment. The enterprise multiple metric is used as a valuation tool to compare the value of a company and its debt to the company's cash earnings, less its non-cash expenses. It's ideal for analysts and investors looking to compare companies within the same industry. Another commonly used multiple for determining the relative value of firms is the enterprise value to sales ratio or EV/sales. It's considered a more accurate measure than the price/sales ratio since it considers the value and amount of debt a company must repay at some point. Enterprise value is a modification of market cap, as it incorporates debt and cash for determining a company's value. It provides a more accurate representation of a firm's value. Enterprise value can change the view of a company's value dramatically when compared to market cap. For example, two identical companies with the same stock price and market cap can have different EVs, reflecting the impact of cash and debt. The price-to-earnings ratio is the ratio for valuing a company, but it doesn't consider the amount of debt that a company has on its balance sheet. This is where enterprise value differs, as it incorporates total debt into the valuation. EV includes total debt, but it's essential to consider how the company's management utilizes the debt, especially when comparing companies across industries. It's best to compare companies within the same industry to better understand how a company is valued relative to its peers. With an example of Macy's, the enterprise value is calculated as the sum of the market value of equity and the market value of a company's debt, less any cash. This calculation provides a more comprehensive alternative to equity market capitalization. Here are 3 key takeaways. 1. Enterprise value, EV, measures a company's total value, often used as a more comprehensive alternative to equity market capitalization. 2. Enterprise value includes in its calculation the market capitalization of a company but also short-term and long-term debt and any cash on the company's balance sheet. 3. Enterprise value is used as the basis for many financial ratios that measure a company's performance. Hope this would help. Thanks for watching.